Well, hello there. This is John Levin, the mortgage guru. So I decided to go ahead and put this video together for everyone out there. Just a little bit about my background. I am a current mortgage loan officer at Loan Depot. I've been in the business for 10 years. I've worked at two national banks, and I'm now out here at wonderful Loan Depot in Scottsdale, Arizona. I'm licensed in 15 states. As a mortgage loan officer, my main goal is to help the American homeowner either purchase the dream of their homes, get into the next home, or refinance to either get cash out or save money monthly. I consider myself pretty good at what I do because I've been doing it a long time and I'm pretty successful. So this video though is really about inflation in 2022. It's right now the hottest topic we have in this country. For the last 2 years, we've had some of the most historic rates and historic market we've ever had. Now, obviously, COVID affected everything in 2020. I understand that. 2020 was just one of those years where it was just crazy. Understand completely. But with COVID, the market rates were floored to the max. We saw some of the lowest rates we've ever seen in the history of mortgages. Trust me. I know. I was pretty busy for 2020 and 2021. It was nuts. With that said, though, 2022 is a different animal. Why is inflation such a huge topic in America? Well, basically, in a nutshell, it's very simple. It's costing you more money. Bottom line, it's taking out of your wallet. The average American homeowner in 2022 is now hurting for $460 a month more. That's due to the cost of goods and services you need to survive going up. I'm not even talking about obligatory debt. We're not talking mortgage payments. We're not talking car payments, credit card payments, store account payments, whatever obligatory debt. We're talking just the basic necessities you want. Food, gas, groceries, utilities, cable, you name it, it's gone up. Now, I don't know if most people understand this, but inflation is at the highest rate it's ever been since the early 1980s. What I mean by that is it's gone up so fast that it's now an unhealthy economy. So typically for a healthy economy, inflation's at 2% per year. That's a healthy economy. Right now we're at 10, double digits. So what's going to happen is the Federal Reserve has now had to step in. So what they've done this year is they've had to step in and jolt the most violent rate hikes we've ever seen this quick, this fast since 1994. You're seeing rates really skyrocket overnight because the Federal Reserve has got to combat inflation. Now, what led to inflation? People are asking, well, why is inflation out of control? There's a couple things that actually happened. One, supply chain issues. You don't have enough supply to meet the still current demand of the economy. So, simple economic theory. When supply doesn't catch up to demand, prices rise. That costs you more money. That's for everything. It doesn't matter what it is. Oil, gas. Now, obviously, they're going to say Russia invaded Ukraine. I get that. I understand that. Russia's got a huge oil supply. They've been sanctioned. The oil's been cut back. Ukraine has one of the largest natural gas pipelines in the world. They produce a lot of natural gas. That's been cut back. However, we have to understand it's not just about Russia and Ukraine. There's a lot of other factors. A lot of the economic policy in Washington is also hurt as well. The Federal Reserve just came out this week and just said they made an egregious error. They kept the rates too low too long. Now, because people have been buying so much, there was so much consumption that the demand was there, the supply was there. But when the supply can't catch up and the consumption doesn't stop, the demand catches up. Now, what the Federal Reserve is going to have to do is they're going to have to hike rates. So basically what they do is they're going to continue to hike rates to combat inflation. When they hike rates, the higher the rate, the more people save, the less people spend. So what's going to happen next? It's a great question. People need to know this. This affects your livelihood. It's called a recession. Now that word that nobody likes to hear. It's coming. Here's the reason why. The Federal Reserve is not done hiking up interest rates. You've already seen a couple this year. They've got a couple more coming. So it's about to get a lot rougher. Now, when the Federal Reserve continues to hike rates, eventually people are going to have to stop spending. They're not going to be able to afford it. You're going to see savings accounts go up. You're going to see spending go down. A recession, hence, recede. Money recedes from the economy into savings accounts. Now, when a recession hits, there's going to be a couple things going to have to, the average American homeowner needs to take into effect. Number one, jobs are never safe in a recession. There's no such thing as a secure job in a recession. You don't know what business needs and business demands have in common. You don't know what's going to happen going forward. So I tell people this: you may have a job today, it doesn't mean you'll have it tomorrow. Number two, keep this in mind: your bills don't go anywhere. They're still good. So even if you don't have a job, you still got to find a way to pay the bills. So most people need to understand that a recession affects everyone. It affects a cross section of the population. It doesn't matter where you come from, who you are, who you vote for. I don't care. The recession will affect you. There's another thing that's going to happen. Once a recession hits, people always do this. They start running up debt. Why? Because if income drops and your bills stay the same, you got to cover the shortfall. So you're going to start seeing a massive amount of default and a massive amount of debt as people try and cover the snowball effect to catch up. Now, the Federal Reserve eventually, once you hit a recession, is going to have to say, okay, we've got a problem. Now you have to go back the other way and lower rates. But for right now, let's talk about a recession because it's coming. It's just a matter of time. You can't avoid it. It's on the way. I tell the average American homeowner to make sure you are prepared. Do not wait until it's too late. Just a little bit of background. I graduated from Florida State University in 2001. I have a Bachelor of Science in Finance. I graduated from the most prestigious universities in the United States, a wonderful school in the state of Florida, accredited, and A grade. As a finance major, I also understand economics. I know money. I've been doing this for a long time. I'm telling you right now that you better get ready. So what you want to do is you want to take your gross annual income from your household. It doesn't matter whether it's W-2, 1099, K-1, self-employed, sole proprietorship, Schedule C in your tax returns. I don't care however you calculate it. Your income is your income. But you need to be ready. So what I tell you to do is make sure that you have 50% of your gross annual income in a liquid savings account that's interest bearing. Do not touch that money. 50% is 6 months. I'm expecting the recession to last 6 months to a year. So even if you want to go above that and you want to go full 100%, that's still a great idea. But you want at least a minimum of 50% of your total gross household income in your household to make sure you survive a recession. Because God forbid if you lose your job, you need to have money set back to pay those bills. Those bills aren't going anywhere. Your job may, bills won't. So what I tell the American homeowner is this: you've had the highest historic equity you've ever had in this country, with last year being an average of $57,000 per homeowner. So take a look at the equity in your home. If you don't sell the home, equity is just a number. It's just a number that is imaginary. Think of the game Monopoly, okay? Guys, think of the game Monopoly. At the end of the day, if you don't sell the home and you leave the equity untapped, you're missing out. You missed out on a historic chance. I tell you right now, look at your liquid savings accounts, and I'm not talking 401k, IRAs, any of that. I'm not talking any retirement accounts. Make sure you have your liquid savings accounts. If you don't have a minimum 50% of your gross household income in there, you need to make a plan right now. And let me tell you this, there's a saying, finance while you are financeable. Let me say this again one more time to you. Finance while you are financeable. If something happens in a recession where you lose your job and you don't have a source of income, you're not tapping into equity because you can't qualify for the loan. You got a sourceable income. So right now, take a look at your savings account. Have this conversation with your family. This is an important conversation to have, because for the American family, you don't want to be stuck out in the cold facing foreclosure, bankruptcy, because you dallied and waited too long. Tackle the issue now. Tackle the issue while you have a chance. So I recommend you have at least 50%. If you don't, start looking at equity home, take it cash out. I don't care what interest rate you have right now. I don't care if you have 1.875, 3.875, 5.875. I don't care what interest rate you have. The only thing more important than interest rates is making sure you have enough money in the bank to survive a recession. If you don't, you will look back and you will kick yourself. You will kick yourself 10 times over. Don't be that person. So if you have any questions, I can be reached at area code 949-652-4528, or you can email me, JLABBAN@loandepot.com. That's like John, Lawrence, Apple, Bravo, Bravo, Apple, November. JLabin at loandepot.com. Thank you so much for watching this video, and I hope it helped.